Good evening. A very warm welcome to this edition of the Rush Hour here on ET Now. We're at the top of our evening primetime rollout of shows. I'm Vikram Oza with the rush of news that we've been tracking through the business day. Right on top is the action taken by central banks around the world. This one in particular is about Turkey. Turkey's central bank has hiked interest rates by 60 basis points now. It almost doubles it. From what was 8.5%, they pulled it up to 15%. And the bank says there will be further tightening until the inflation picture in the country improves. Then there is Norway's central bank, which has also raised key policy rates by 50 basis points to now what is a 15-year high there of 3.75%. It comes after a 50 basis point rate hike from the Bank of England as well, which is also at a 15-year high. And the US's Federal Reserve, although they did not change those key interest rates, they remain quite hawkish, calling for at least 2 more rate hikes in the second half of 2023. So how are we doing as far as central bank action is concerned against rising prices around the world? Let's get perspective on this from Arnab, Global Market Strategist at Invesco. Great to have you with us this evening. Arnab, do tell us, as far as central bank action goes for the fight against inflation, rising prices after the pandemic, we've seen demand really rise, and on the back of which, globally, we've seen this fight against inflation by the central banks. How have they done so far? Because to be able to see that cool off, it seems the battle is not over yet for most central banks, isn't it?
Yeah, I think that's right. I think, there are quite some differences from one central bank to the next, but the common thread is that growth and inflation are both proving more resilient and persistent than everybody had hoped. I guess, there are different things going on, like I said, in different places. In Turkey, it's an extremely different situation, right? They had been under Erdogan's previous central bank governors. Several of them had been cutting rates to lower inflation. So they have really a great deal to do. I think for the Bank of England, they were the first of the major central banks to really be quite hawkish way back in December 2021. But they've spent the last year and a half sort of soft pedaling on rate hikes, I would say. And growth and inflation have been surprising to the upside, especially wages last week and inflation this week. And so they had to move much more forcefully. There's still some doubt about how much further they're willing to go. The market is pushing them to price up towards a 6 or even higher than 6% base rate. We'll see if they get there. They've sort of undercut some of the hawkishness in their statement. But I think the general direction of travel is that central banks are going to have to be more hawkish for longer. Rates are going to have to be higher for longer than expected. And then on top of that, today, as you may have seen, these very weak PMI, manufacturing flash PMI numbers in the Eurozone, which I guess is making the market think, okay, well, central banks have to be very hawkish because of the inflation problem. Meanwhile, growth, or at least manufacturing, very important in continental Europe, slowing quite sharply. So the chances of a recession are rising, right? That the recession may happen, may be required to bring inflation down, may be harder than people had thought.
Indeed. Yeah. But one would have also thought, Arnab, that China, coming out of the pandemic, removing COVID restrictions, the economy would actually help global economy grow that much more, demand would be that much higher, and the battle against inflation that much tougher for central banks. That hasn't quite happened. So has that, in effect, helped central banks be a little less aggressive in trying to control demand, considering that China's output and their entire ability to spur the global economy hasn't gone exactly the way they had hoped to?
Look, I think, it has some effect. I think you're right at the very incrementally. But I think the big picture is that the inflation problem is about domestic demand and about very tight domestic labor markets in most of the West. So it's true, I think people had expected, including ourselves, that there would be a stronger rebound in China. And we're still hopeful that there'll be some more stimulus and that will help propel the Chinese economy forward. But I think it has to be said, China had a much more significant lockdown than most other countries and had much less in the way of monetary and fiscal support during the lockdowns than the other very large economies in the world. So they haven't had kind of the bust and boom and ongoing boom in spending that many of the Western economies have had. They have had a recovery, but it's just not been as strong as all that. So as you say, that has imparted less inflation pressure to the rest of the world, but that's not enough, I don't think, to offset these domestic inflation pressures, because it's really all about services and wages, rent, and various other kinds of domestic prices rather than internationally traded goods prices at this point.
And yet, Arnab, there is a certain link in terms of the growth of the services sector, which has remained quite resilient, unlike what you're seeing in manufacturing. Has that been reflected in how the global economy has recovered post-pandemic? And is that reflecting in the global markets as well, services counters versus manufacturing counters?
Yeah, look, I think it's it's absolutely one of the big themes that has been taking place during the whole pandemic and its aftermath, right? During the pandemic, when we were all locked down, we couldn't spend money on services and experiences and travel. And so people shifted their spending towards goods and home improvement, and, Peloton, exercise bikes, so-called work from home stocks did very well at that point because of that shift in spending. When the reopening occurred, after the vaccination, permanent reopening, people really went off to the races on services. And now goods spending continues to tail off as services spending continues to be quite strong. And meanwhile, we still have, some of the aftermath, particularly here in the United Kingdom, to some extent in the US, less so perhaps in the Eurozone. We still have some of the aftermath of COVID where, the labor market is very tight, partly because labor demand is very strong, especially for these services jobs and construction jobs in some cases at some points in time. But also labor supply has been restricted because of the Great Quit, the Great Resignation, early retirements, and also, particularly in the case of the UK, so-called long COVID, right? So a lot of the COVID aftershocks are playing through in services markets, in goods markets, commodity markets to some extent. Of course, the war has an important effect there too.
Yes.
And indeed in labor markets.
And of course, we are going to watch this trend of central banks hiking interest rates, some of them more hawkish than others. At this point in time, that battle against inflation continues. How soon before we reach a pause and perhaps a pivot in different parts of the country? Like you said, it's a domestic issue as well, and different countries and different central banks will have to deal with it differently here on. That remains a watch at our end. Thanks, Arnab Das, for joining us with your perspective on this. Appreciate you joining us on this edition of the Rush Hour.